Today a video to go through a little bit of the methodology we went through yesterday to find the trade in Tesla, right? That's the new series we start beneath the surface, ultimately, where we're trying to go a little bit deeper and further than just VRP trades. Obviously, that's always where you want to start, but then once you have some information about it, how do you actually try to implement a trade that makes sense with it? And for that, you need to have a good view on what the vol surface does look like to try to express your edge as best as possible. So as usual, we start with the research paper on the VRP. This column right here is one of the most meaningful you can get, because ultimately we make a prediction of whether implied volatility measure either at 9 days or 30 days is going to be above the realized volatility over the next 9 days or next 30 days, right? So it's really something that's forward looking. And in my opinion, you should always start there. At least that's how the tool is built. Use that forward-looking forecast to get an idea of what you want to do as a trade. Obviously, when you look at 9 days right now, you have a few interesting names. You see GME here, and you see Tesla there, right? I didn't even have to do any filters. That was just top of the board, and I was like, okay, well, that's interesting. Let's try to dig deeper into that. A little bit of comment on the color code. So ultimately, when it's blue like this, when it's a blue bubble, and then you have the up arrow, what we're really predicting is that the VRP, you should long the VRP. So ultimately, we're saying implied volatility at 9 days is going to be most likely lower than realized volatility for the next 5 days. So if you were to strike a trade at whichever IV you have in Tesla right now, let's say 50 for the sake of it, it's very likely that we will see something over the next 9 days that will be over 50. So you don't really want to be on the short side of options. You probably want to be more on the long side of options, and that's something to keep in mind. The value you see here, that's the current value of the VRP. So ultimately, this is also telling you that right now you have a positive VRP in Tesla. So, and that's really the starting point, right? How do you want to structure a trade here that makes sense, given that the VRP is still positive at roughly 9 days? At 30 days, well, Tesla is not there, but we can look for it right here. At 30 days, it's even more pronounced, right? So if you just go blindly buying straddles, buying strongholds, you're probably going to suffer a little bit. And you need to see with the data, how to read the data to try to express that trade or that probability in the most meaningful way. One of the first thing that's quite striking, right, is that we do think that ultimately implied is going to be lower than realized over the next 9 days. But for the next 30 days, it's not as clear cut, right? 50-50, it's flip of a coin. You don't want to overread this too much. But it seems like something's happening in the short term. So at least let's try to go and see why there's this kind of numbers at the moment. If we look at like a few interesting charts happening in Tesla, right? So that's the dashboard. I switched. I've already obviously prepared a little bit. I switched to some pre-configured chart. Let's start with realized volatility. First of all, it's pretty clear that right now at that moment, the realized volatility in Tesla is quite compressed. We don't expect stuff to jump too much, but you never know, right? And ultimately, this forecaster is really good at predicting what's been the average realized vol for a given ticker. It doesn't take into consideration external factors or even the dynamic in the vol term structure, in the vol surface, which ultimately is probably a better predictor. So when you look at this, it's clearly at the lowest. And then some of the interesting stuff I was talking about in the article yesterday is two things. First of all, it's the vol of vol chart. So as you see, it's not at the lowest of the lowest. We've seen lower than that, especially deep in the summer where really nothing was happening, or when everybody was recovering from quite an intense month of April. and then I think it jumped back because you had I think this period here is the tweet thread between Trump and Musk, quite entertaining. But since then, really not a whole lot has happened. Vol of vol is quite low. So ultimately, when vol of vol is stable, it usually means that people are, not willing to overpay for tails. They don't think something crazy is yet to happen, but that stuff can spike pretty quickly and pretty fast. So you always want to keep an eye on it. If you Z-score rate right now, a -1, it's probably on the lower end of the spectrum. So you also want to be mindful of this and be a little bit and be a little bit careful, right? Like, don't obviously I try to not give too much weight to one specific metric, but at the same time, like we use Z-score for a reason, and that Z-score is at -1 right now. So yeah, when you look at this, it starts to be one of the little cues you want to potentially use. The other one I spoke about, which to me is a much bigger cue, is this one, the spot vol correlation chart. So right now you have a spot vol correlation of 0.2, right? So if you think about it in returns term, it means that like when Tesla goes down right now, it's not a given that vol is going to go up. In fact, it's quite the opposite. When Tesla goes down, it looks like more likely that vol is going to go down, and then when Tesla goes up, the vol is going to go up. Implied vol, right? Obviously. That's very telling of a few things. First of all, it means that people are not particularly scared of downside move in Tesla right now, so they're not willing to pay for options when they see movement coming up because they're thinking, okay, that stuff is probably going to resolve itself. And the fact that it tends to go on the positive side means that you have a shift of where people do buy option, right? Like now they do buy option, they buy calls when the stock is going up. It's not that it's a bad thing or a good thing. It's just that it gives you an idea of what's the mindset is. You have a great way to experience this right now. When Trump got elected last year, obviously it was extremely positive for Musk because he invested quite a bit of money to get himself elected. So people were buying a lot of calls. So every time Tesla was going up, ultimately you would see vol go up, right? So a little bit of a reverse in the mindset. Right now, it seems like we're going into that direction again. Interesting. So we have basically a regime where volatility is quite low. Volatility, so volatility of implied volatility, once again, is also quite low here. And it looks like the market is paying up for option when you have rallies on the upside and not move on the downside. That is also in line with what you see overall here, right? Like you look at the implied vol in Tesla, it's been tamed throughout the summer. The contango is pronounced enough. So when you have all of those little elements in mind, we are thinking that ultimately here that may be a little bit low, or at least it's likely that it could be challenged by a spike in realized vol, right, at some point. So how do you think of structuring a trade in there? And that's where you want to switch to the vol surface. So let's start with the beginning and have an overall look at what the surface looks like. So it looks cheap on the short tenors, right, from 3 to 21 days. You have something that range from 43 to 48, 50s in the tails, but then as soon as you start to go in the back month, you start to see implied volatility going much steeper and high in the 50s. So it's basically in line with what we've just said. Like it's a market that doesn't expect something major to happen in the short term, but because it's Tesla, because there's so much hype, because there's so much chatters and stuff happening, it's a market that also doesn't want to be oblivious on risk. And as soon as you arrive at 45 days, they're willing to buy options again. Also, I think that right around here in that region, I'm pretty sure you have earnings in Tesla coming up. If you look at the Z-score, yeah, I mean, it's in line with what we saw right here. Vol is low right now, and this is reflected in the entire vol surface. Let's now switch to a much more important metric, and the metric we started with. We were basically saying that, like in the short dated options, it is likely that the VRP could be compressed over the next few days, more specifically 9 days, right? So here we're basically saying there's about 8 points VRP. You'll see a difference because of the way these numbers are calculated. So you'll see some difference once in a while. But if you want to get a good proxy, usually you want to compare the 20 delta strong at around 10 days, and you can compare it with the value you'll see in the VRP here, which start to be a little bit closer. You have 8.2 here, you have about 7.5, 7 there. So it's a little bit closer to what you see. So how is that a high number? Is that a low number? That's really the question you're trying to answer, and that's the kind of stuff you'll see with a Z-score. But at least what's very striking is you have 3-5 points of VRP, especially at the money here in the front weeks, when you have 13-14 points in the back week. So once again, the default thinking when you read Reddit forums, social media, people are always happy to sell calls, covered calls on some stocks. The margin for error is extremely thin, right? If you have a little bit of a spike up in Tesla, especially with spot vol correlation being positive these days, it's very likely that your calls here are going to be challenged very quickly, because basically when you short the call, well, you short delta first of all, so you don't want obviously the stock to get too close to your strike, but on top of that you're short vol, and with spot vol correlation on the rise, it means that a move up is likely to get you lose money on the Vega side. So it's really double punishment. So selling those calls here is probably not the best idea, right? You don't have an amazing margin for error. If you really want to do something, it's probably a little bit safer to come here. You have 16-point VRP. That's probably a little bit easier to extract something out of there. If you start to Z-score that stuff, you'll see that what we're saying is extremely explicit now and even clearer. Basically, you have negative VRP in those tenors. If anything, what that tells you is you want to buy those options because you never know what's going to happen. And in fact, we do know a few things are yet to happen, right? We know that tomorrow and Thursday we have some inflation numbers. We have some Fed FOMC in about a week. And then you have quarterly expiration right after the FOMC meeting, 2 days after that. So the next 10-12 days are to be quite busy. So, if you're looking for cheap gamma, if you're looking for stuff that might move, you have something that you can look into here, which is again quite counterintuitive, because most people love to sell zero DTs or short dated option, and they make a big focus on the theta. But right now here, what that tells you is that really hedge is not on your side. The combination of spot vol being positive and VRP being very thin, you probably don't want to sell those options. If you want to sell some options, you probably want to consider more something around here. So subject once again that I think that the earnings are somewhere mid-October, I would say maybe last week of October. So that would mean we're the 8th today. So yeah, that would be around here, 40, 49, which again makes sense, right? The market doesn't make you rich for no reason, doesn't going to give you gift. And if you see a stretch VRP here, that's probably because the date is around that week. But before that, a month out, so early October, you're probably fine, right? Like you can start considering these things right here. And again, like you see that people tend to overpay for calls more than they pay for puts, which is again in line with the stuff we were describing with the spot vol correlation. So when you have that thinking in place, there's multiple things you can consider. One of the first one you want to consider is if you don't want to overthink, you can just simply probably strike something that looks like a 20 delta stronghold, and you can probably get away with it. But it wouldn't be fully aligned with what we were saying here, right? Like we expect VRP to be a little bit challenged, especially in the short dated option. And here it's basically flip of a coin. So you could get away with it, but really the hedge is not fully on your side. And this is where this stuff start to be interesting, right? Like we specifically on the skew side, we say we think the skew is gonna go up. So the skew is basically the measure of the calls versus the puts. The way we do compute skews here is we do compute each node against its respective option at the money, right? So for instance, here the 20 delta call is 106 above the price of the money from an implied volatility perspective. And here you start to see some interesting stuff. Obviously, people always pay for tails, especially in Tesla. But you look at this one, for instance, you basically have almost no skew, even negative skew. So people tend to be selling a lot of puts in Tesla for some reasons right now. Again, those puts are not particularly cheap from a realized volatility perspective, right? Like you still have 13 points. So there's some arguments to go into that direction. But if you expect vol to go up at some point, and if you try to look where the market is ill positioned, well, here it's pretty clear that those stuff are potentially cheap regarding or in comparison to those options and those calls here. So we were fine selling those calls. We knew that it's basically not amazing to be fully short vol these days in Tesla, right? The hedge is not necessarily on your end. And it turns out that those puts here are cheap, right? So that starts to be a very solid thesis for doing a risk reversal where you would sell something like 20, 30 delta calls and then use the proceed to go buy something like 20 delta or 10 delta puts in Tesla. You don't even have to go there. You could probably get a little bit closer, but that's the thesis, right? Then after that, you structure it the way you want, something that fits your portfolio, and that really depends on everyone. But here, that's really what the surface tells you right now. Like the options in that band, 35 delta, 35 DTs, tend to be a little bit expensive, but then in that band range, it looks like the calls are too expensive in comparison. You don't want to do that without overthinking, right? Like, because if you just sell the calls and buy the puts, it's basically a lot of short delta in the stock. And if it rallies, you're going to be in trouble. So you could decide to do this kind of position again, while Tesla shares that you own, or you could decide that, okay, at the portfolio level, I already have plenty of positive delta because overall it's a regime where VIX is at 14, 15 these days. It's much better to be long stock overall than just being short. Doesn't mean the market cannot go down. And precisely because the market could go down, maybe buying a few of those puts here and selling a few of those calls here is a great way to add some negative delta in your portfolio and ultimately balance the risk. So really you have three options, right? Like you can just come probably buy again some puts here, or really like at the money straddles in the front weeks in Tesla, because at the moment this is where options are the cheapest. You could add a 20 delta stronghold at around 30 days and against that stuff, right? Obviously. Or you could just go risk reversals, short risk reversals, shorting some calls, and then buying some puts. Same idea in that 42, 35 delta. Sorry, days to expiration tenor. So that's about it for the analysis beneath the surface on Tesla. I hope that it was useful. We'll be doing a lot more of those analysis over the next few weeks, not only to present the platform, but also to guide you on how to use a lot of those metrics that should be used a lot if you want to ultimately make some much better decision when it comes to trading. You can't just simply sell calls because you like the credit or because you think that you've saved 3% out of the money. The answer is always in the data. Most of the time, the answer is in the vol surface, and that's the reason why we spend a little bit of time looking into this. All right, see you around.